Unit 4. I think this is my favorite macro unit, financial assets. This is like stocks, bonds, and bank deposits. A stock is the ownership of a company. If you own a stock, you own a little piece of that company, and that means you're guaranteed a portion of their future profits, often called a dividend. A bond is like an IOU from a company or a government to you, the investor. They're going to pay you interest because they need a little loan. Bank deposit is like a checking account or savings account. You might have one of those. An interest rate. This is a really big and important concept in macro. You're going to hear this word a lot. It's just the cost of borrowing. You usually have to pay an interest rate on a loan, or if you give a loan, you're going to get paid an interest rate. The lower the interest rate, the more business investment we should see. That's really important for growth. Liquidity. This is how easy you can convert an asset into a medium of exchange. So the cash currency in your wallet is super liquid. It's already a medium of exchange. Real estate, like a house or an apartment building, is illiquid. It's really hard to turn that into cash because you got to list it and sell it and get it inspected, and it takes a long time. Stocks and bonds are in between cash and real estate in terms of liquidity, closer to cash though. A bond, again, this is like an IOU that a government or a company owes you. It's a loan, and they're going to pay you interest on it. Usually issued by businesses or governments. If it's from the United States government, it's usually going to be called something like a T-bill or a treasury note. Lenders versus borrowers. A lender is the supplier of a loan. It's a bank. Again, why do banks give loans? So they can charge an interest rate. That's how they make money. A borrower is the demander of a loan. That's usually investors. It could also be the government, though. We'll talk about that soon. Investment. In macroeconomics, investment does not mean stocks and bonds. That can be confusing. Investment in macro means business spending on capital stock, machines, tools, and technology. Why do they buy that stuff? To make them more productive, so they can make more stuff and grow. The three functions of money. It's a store of value, so you could keep money and then use it later in the future. It's not going to lose a whole lot of value unless there's some inflation. It measures value, so it's really easy to keep track of how much things are worth. You don't have to think about how many seashells a car is worth or how many goats you would trade for a house. And it's also a medium of exchange. This is the most important function of money, at least the most practical one. It means we don't need a barter system. If you want to buy something, you just use money. You don't have to go seek out whatever it is that the seller needs at that time. They'll take money. M1 versus M2. M1 is super liquid. It's cash and demand deposits, bank checking accounts. M2 is a little bit less liquid. This would be all of M1 plus some slightly less liquid things like savings accounts or CDs or money markets. These two asset classes, M1 and M2, don't earn very much interest compared to stocks and bonds, but because the risk is really low, you're not going to get paid very much interest, and that means with high risk, you should be earning a higher interest rate, or at least returns on your investment. The monetary base. This is controlled by the Fed or the central bank, and it's the total currency in circulation in an economy. It's the paper bills plus the coins. Fractional reserve banking system. This is where the magic happens in the economy. No Illuminati necessary. Banks accept deposits, and then they take those deposits, or at least a large portion of them, and loan them out. They loan out a portion of those deposits. That's how banks make money. Of course, they have to keep a little bit of it, and the amount that they have to keep is what's called the required reserve. It's up to the central bank to decide that. Demand deposits. This is like a checking account. So if you open an account at a bank and you put money into the bank, it's usually going into a checking account, and that's considered a demand deposit. It's a liability for the bank on its balance sheet. You'll see those in class. And those are on the right side of the balance sheet. Required reserves. This is the minimum amount of deposits that the bank has to keep. They cannot loan out their required reserves. They have to keep it in the bank. A bigger required reserve ratio means smaller money multiplier because less loans can be made. Excess reserves. This is the money that a bank could loan out. They could loan it out, but maybe they haven't loaned it out for whatever reason. You can calculate it by taking total reserves and then subtracting required reserves. That's going to give you excess reserves. The money multiplier. To calculate it, just divide 1 divided by the RRR, or the required reserve ratio. You should have nice and round numbers. How much the total money supply changes when $1 is added to the monetary base. Maybe it's 10 or 20. So when the Fed puts a new dollar into the economy, if the multiplier is 10, that $1 will turn into $10. The money market. Finally, a graph. The money market shows the relationship between nominal interest rates and the quantity of money, and it also shows how the Fed can influence the supply of money. So here we see nominal interest rate and quantity of money. Demand for money is coming from within the economy, like households. The supply of money, this is the Fed, the shifters of the money market. Well, notice, I've only got demand here. That's because the supply of money is totally controlled by the Fed using open market operations, the required reserve ratio, or the discount rate. We'll talk about those soon. For demand for money, here's what matters: price level. If inflation is happening, people are going to demand more money. If incomes go up in the economy, that means we should see money exchanging hands more frequently and more transactions taking place. That should be more demand for money. And finally, financial technology. This is a cool one. If new credit card technology is introduced that makes it easier or more convenient or more secure to use a credit card, people won't have much demand for money, so that would actually result in less demand for money. Sorry, I left out the labels. The central bank, sometimes called the Fed or the Federal Reserve. This oversees the entire U.S. banking system, and it controls the monetary base. It influences the interest rate through monetary policy. Unlike fiscal policy, which is controlled by elected officials or the government, Congress, the Fed operates separately, although they are appointed. Monetary policy, controlled by the Fed. The central bank changes the money supply or influences the interest rate through required reserve ratios, the discount rate, open market operations, and the federal funds rate to try to manipulate the economy, maybe fix gaps, heat it up, cool it down, reduce unemployment, decrease inflation, whatever it might need to do. Here's the first tool they have, probably the most important: open market operations. This is when the Fed, central bank, buys or sells bonds to try to influence the economy. Here's how you remember how this works. The first letter of buy bonds is B. The first letter of bigger is B. So when the Fed buys bonds, the money supply gets bigger. That means it's expansionary. Money supply shifts to the right, the interest rate goes down. If they sell bonds, again, first letter is S, first letter of smaller is S, sell bonds, that means the money supply gets smaller. That's how you remember it. That's contractionary monetary policy. The money supply shifts in, interest rates go up, quantity of money is lower. The discount rate. This is the interest rate, or the cost of borrowing, that the central bank charges on loans to privately held commercial banks. A lower discount rate, that's a lower interest rate, is expansionary because more loans will take place. A higher discount rate is contractionary. Less loans will take place. The federal funds rate. This is the interest rate, or cost of borrowing, charged between commercial banks on loans, and the Fed can influence it, although it technically can't change it directly. It has a big influence on it, though. The required reserve ratio. This is the percentage of demand deposits that the bank has to keep. It cannot loan them out. This comes up a lot on bank balance sheet free response questions. Public and private savings. Public savings is just government savings. This isn't that common. A lot of governments run deficits. Private savings. This is what private households save. So instead of spending money, maybe they save money. This varies a lot from country to country. The loanable funds market. Simple looking graph. It looks like supply and demand. Upward sloping supply of loanable funds. That's from lenders and banks, and demand for loanable funds. This is borrowers and investors. It could also be the government. The real interest rate on the y-axis, real interest rate, And on the x-axis, we have the quantity of loanable funds. IRE, equilibrium interest rate, QE, quantity of loanable funds. Okay, the loanable funds market shifters. First one for demand for loanable funds is changes in private borrowing. Maybe there's more demand for investments because of a change in taxes related to investments. Public borrowing could be something like deficit spending. That's when the government is spending more money than it's taking in from taxes. Well, in order to fund that spending, they have to borrow. This can sometimes cause what's called crowding out. When the government borrows money, it can drive up the interest rate and push out private investment. Try to remember that, crowding out. The supply of loanable funds. This is shifted from any change in capital inflows or outflows. That's from other foreign countries. Don't worry, that's not so important in this unit. It'll come back up later in the course. More or less public or private savings. Again, this could be something related to a change in incentives by the government to get people to save more money. Perhaps they reduce the interest earned income tax. That's it, guys. Thanks for watching.